Good morning. What happens if the Fed cuts rates too soon? A mortgage expert's breakdown. So, as the market waits for the Federal Reserve's next move, home buyers and investors are already asking the big question: what happens if the Fed cuts rates too early in the process? Well, a premature rate cut may sound great on the surface because we get lower rates and more affordability, more loan volume. But history also shows it can lead to inflation flare ups, market volatility, and pricing whiplash that impacts every mortgage borrower. And that's the balancing act that the Fed has to do. So here's what you need to know. Number one, lower rates could restart the housing demand overnight. And I hope that's the case. If the Fed signals one early rate cut, mortgage rates could fall 30 to 75 basis points immediately as markets price in a looser policy path. That's an optimistic case for tomorrow, I think. But what that means is buyers that have been sitting on the sidelines will jump back in. And as well, investors return to acquisitions that may have been stalled, refinance pipelines reopen, and competition is going to intensify, especially in Texas growth markets like Katy, Fulshire, and Houston. But what if inflation isn't truly under control and this demand boom could backfire? It's a thought. Number two, inflation could reignite, which could push rates back up. So that is the real risk of cutting too soon. It risks undoing the progress made of taming inflation. Now, if the consumer price index, CPI, or producer cost estimates heat back up, bond yields rise. Mortgage rates then also jump again. And housing affordability worsens as a result. So borrowers who waited could get caught in another rate spike up and down, or down and up, excuse me. But this happened in the 1970s, and even small premature cuts caused major inflation rebounds. And I hope that's not the case here, but it's something worth talking about. Three is volatile rates create unsafe conditions for buyers and investors. So mortgage markets, they hate uncertainty, as do most people. And a seesaw of falling and then rising interest rates creates a situation where you have pricing whiplash, where people are like, well, what is it? It could result in slower underwriting and rate lock windows as pipelines fill back up. And it also could lead to more extension requests for secondary market desks. So it also leads to challenges for construction loans and DSCR loans, which longer escrows. Now, for borrowers, the risk is simple: lock low too early and inflation spikes, rates jump, and deals fall apart. Number four, early cuts signal something else: economic weakness. So if the Fed cuts early due to recession fears, the ripple effects could hit real estate as well, which could mean lower demand for commercial spaces. It could mean business contraction. It could mean slower household formation. And tighter lending from worried banks about their commercial real estate exposure is another outcome. But this is exactly why mortgage brokers must properly position borrowers, not just chasing the lowest rate. Number five, banks may tighten even as rates fall. So lower rates don't automatically mean easier lending. And if a cuts occur during economic stress, banks could pull back on their leverage in response to it. DSCR thresholds could rise, and they can spend more time scrutinizing appraisal increases, which makes conditions that get tighter on both bridge and construction loans as well. And this is where Medallion Funds becomes a key differentiator for our clients. We have multiple lenders, flexible programs, and options outside of traditional bank underwriting. And number six is smart borrowers prepare before the cut. So the winners of the next cycle will be those who go out and get pre approved early, who review their documentation now. And you'll also have a strong understanding of DSCR, DTI, and reserves fundamentals. But when rates do move, be prepared to lock fast when they move. And if rates fall quickly, pipelines flood. And if they bounce back, only the prepared borrowers are the ones who can actually secure the deals because they took the action they needed to. So here's the final takeaway for the day. A Fed rate cut is not automatically good news. And if it happens too soon, the result could be sudden demand surges, inflation spikes, volatile mortgage pricing, because when the secondary market moves, so do rates and pricing for lenders. And also, it could result in tighter lending despite the lower rates. So, the takeaway here is the smartest move is work with a mortgage broker who can move fast, shop 600 plus lenders, and guide clients through a rate environment that may shift rapidly. And good news, that's exactly what we do here at Medallion Funds. If you want some more information, please visit my website, billrapponline.com. You can schedule a consultation, and there's also some free tools. Thank you for your time. Have a good day.